The Federal Reserve cut interest rates 3 times in 2025, beginning in September, for a total reduction of 75 basis points. This brought the Fed funds rate down from its 5.5% peak to 4.25% by year-end. But the pace of cuts was slower than markets hoped. The constraint, core PCE. Inflation remained at 2.6%, above the Fed's 2% target, and tariff-driven price pressures kept policymakers cautious. Fed Chair Powell consistently signaled a data-dependent approach rather than a pre-committed cutting cycle. Looking to 2026, the Fed's own dot plot projects just one additional cut, bringing the Fed funds rate to approximately 3.4%. This higher-for-longer stance has major implications. Mortgage rates remain elevated, corporate borrowing costs are higher than the zero-interest rate era, and the equity risk premium is compressed versus historical norms. For investors, Fed policy is the single most important macro variable to monitor in 2026. Federal Reserve rate cuts send ripple effects through every asset class, and understanding the direction and magnitude of those effects is essential for portfolio positioning. Equities benefit as lower discount rates boost the present value of future earnings. Growth and technology stocks benefit most. This is one reason the Nasdaq outperformed in 2025. Real estate and rates respond positively as mortgage rates fall. The 30-year fixed mortgage rate dropped from near 8% at its peak towards 6.2% by end of 2025, beginning to unlock housing demand that had frozen at higher rates. Long-duration bonds, TLT and AGG, see price appreciation as yields fall. Bond duration becomes an asset in a cutting cycle. The US dollar tends to weaken as rate differentials narrow. This boosts returns on international assets for US investors, a key driver of the 27% to 30% returns in developed and emerging international markets. And gold surged 60% in 2025, partly because lower real yields reduce the opportunity cost of holding a non-yielding asset like gold. The one risk: if tariffs reaccelerate inflation, the Fed may pause, or even reverse. That scenario would upend all of these relationships simultaneously. This is the disclaimer slide. All content in this presentation is for educational purposes only. It does not constitute investment advice. Viewers should consult a licensed financial advisor before making any investment decisions.